Welcome to Team 11's final presentation. We will be discussing Southwestern Energy. Those in the know call it SWN. SWN is a North American natural gas producer. They produce 4.6 billion cubic feet of gas per day. 87% of production is natural gas, 13% of production is a combination of oil and natural gas liquids. For this presentation, we're only going to talk about the gas. SWN has two customers: intermediaries, which are pipeline companies and natural gas exporters, and end users, so power plants, chemical manufacturers, and general industrial manufacturing. Sales contracts take two forms: baseload, which is selling longer duration contracts for future production, and spot sales, which are selling gas today at whatever the price is today. SWN's customers are geographically dispersed. 65% of production is sold to the Gulf Coast. 26% of production is sold to Appalachia. Appalachia is an industry term for Pennsylvania, Ohio, and West Virginia. A third of natural gas production is sold to LNG markets. And finally, 6% of production is sold to Citygate, which is an industry term for domestic use, like household use. Each user has a different customer value equation. Intermediary customers, like a pipeline, they value Gulf Coast access. That's because there's LNG facilities, chemical manufacturing plants, lots of end users located on the Gulf Coast. They also value durability. They're purchasing large volumes and long contracts, so they want to make sure that SWN is able to perform over the duration. They also value proximity, so how close is the user to the rock that the gas is coming out of? The shorter the distance, the lower the cost. And finally, linkage. How well does SWN get the gas to an access point? End users value proximity the most, lowering costs. Durability is also very important. They want to be sure that SWN will be able to perform in the long term. Linkage is also important. Because end users are geographically dispersed, Gulf Coast access is less important. And finally, RSG, or responsibly sourced gas. SWN has taken steps to improve each aspect of this value equation for customers, and the following slides will talk about each of these points. Proximity and Gulf Coast access. Natural gas production is controlled by geology. So natural gas is not produced in Minnesota because the rocks that are necessary were never deposited there. There are 36 states that do produce natural gas, and so why would you operate in a particular location? The Appalachian Basin is optimal because it has a lot of oil and gas infrastructure already in place. It's near large cities and industrial markets. Additionally, Louisiana is close to LNG export facilities, refineries, and chemical manufacturers. SWN used to only operate in the Appalachian Basin, and in the last few years they integrated the northern Louisiana asset called Haynesville to have better access to the Gulf Coast. An added benefit of this two-basin model is that idiosyncratic events won't disrupt the entirety of their production. That means that if there's a hurricane in Louisiana, the operations in Pennsylvania are not affected. If there's a snowstorm in Pennsylvania, Louisiana is not affected. To improve durability and linkage, SWN integrated their upstream services. So when an operations company wants to drill an asset, they usually outsource it to a third party. And once they're flowing oil or gas, they have to gather it to put it into a pipeline, and that gathering process is normally a third-party vendor. SWN integrated these processes, and this gives them maximum flexibility in the timing of their operations. It lowers their variable costs, and that savings can be passed on to customers. And the downside to this is that it increases their fixed costs. SWN also integrated a marketing department, which is somewhat unusual for this peer group. So the marketing department coordinates with operations to pick the optimal time to drill and optimal way to distribute gas to the customers. Additionally, the marketing department handles the baseload and spot price contracts. Finally, RSG, Responsibly Sourced Gas Certification, is required by certain financial institutions for access to capital, and it's also required by certain utility companies for their vendor contracts. So to maintain optimal access to financing and customers, SWN fulfilled RSG certification processes. We selected Antero, EQT, and Range Resources as competitors for which to compare Southwestern Energy. We picked these companies because they all operate in the Appalachian Basin and primarily produce natural gas. So up until recently, Southwestern also was a one-basin operator focusing on natural gas. The recent addition of the Haynesville allows a nice contrast to these other companies. In this slide, we're looking at the price of natural gas that's realized by all these competitors. The top figure is the spot price of natural gas that changes every day. We're looking at a long period in time. The low is $2, the high is $14. I want you to focus on the right end of this figure, which represents the spot prices of last year. The high is $8.81, the low is $2.31. That's a huge range. That type of change in pricing will have a significant impact on any company's revenue. The table on the bottom shows the realized prices of the various competitors. Before and after derivatives effects represents hedging, which is that long-term contract that you can sell future production at. The consequence of having that long-term contract is that you get lower pricing. So SWN engages in a lot of hedging, meaning that they have the lowest prices of their peer group. And in contrast, Antero has almost no hedging, and they have much higher realized prices. On the bottom row, we are showing the operations costs for all of these competitors. SWN has by far the lowest operational costs, and that's a result of integrating their oilfield services. This slide is showing the percent of future production that has been sold today. You can focus on the right side of this figure. So as of 2022, SWN had sold 45% of their following year's production, and then they had sold 32% of their 24 production. In contrast, Antero had only sold 4% of its 23 production as of last year. So Southwestern is guaranteeing revenue and guaranteeing that it gets an adequate price, but they're losing the opportunity to have elevated revenue if prices surge. Antero is on the opposite side of the spectrum. They're allowing themselves to achieve the highest price possible by selling on the spot market. However, they're exposing themselves to the risk of prices bottoming out. Let's take a moment and step back and talk about natural gas consumption in the United States. In 2022, the United States consumed 32 trillion cubic feet of natural gas. Interestingly, our storage capacity is only 4.2 trillion cubic feet. The implication is that natural gas produced is instantly consumed, and that there's very little buffer for our market for any kind of disruption. So if there's a major snowstorm and supply of natural gas is consumed, we have about a month's worth of natural gas stored to help maintain our lifestyles. So this environment yields high volatility in price point, and that high volatility needs to be dealt with in a business model. SWN's business model handles that extreme price volatility by lowering costs through the integration of their field services and also by the increased hedging. So they're able to prevent the lowest prices from happening. This slide shows a SWOT analysis, and we've already discussed all the points that are in this slide. This slide shows Porter's 5 forces, and again, we've already discussed all these points, so I won't rehash them. Finally, we're on recommendations. We mentioned earlier in the presentation that 1/3 of their natural gas production is sold to LNG facilities. They can create value for their LNG customers by investing in liquefaction facilities. So by vertically integrating liquefaction, they can reduce their costs and have a more competitive selling price to LNG consumers and also maintain their margins. On a separate point, they can increase their spot sales and reduce hedging. And so different customers are engaging with spot sales than with LNG. They value the flexibility that a short-term contract has. So if SWN spends effort engaging with those customers, they'll be able to yield a higher average realized price, which will help their revenue. Thank you.